why do we care? I mean, why do we actually care about the VWAP in share trading? There's really only one main time that this actually comes up, and that is with an equity raising. So, as I explained in a previous video, one of the core function of why the share market actually exists is for a means for companies to raise capital, to raise money. They can do that through an IPO, but then once they're listed, if shares bought and sold, which they are all day, every day, the company doesn't actually see that money because it's going from one investor to another. But what happens if a company actually wants to raise more money? Well, they can do that with an equity raising. And they'll usually do this at both an institutional level and a retail level. That's not so important for this conversation. But retail, I mean, you guys are retail, right? Individual investors. Institutional are like superannuation funds, etc. So what a company might do is they will offer existing shareholders the opportunity to buy new shares. Now, why this becomes difficult is, well, what price is fair to offer those shares? So let's say that the company is trading at $11 for argument's sake. And they do an equity raising and they give existing shareholders the opportunity to buy more shares. Well, the problem is that the market capitalization or the market cap of a company is equal to, so that's how much the company is actually worth. So it's a big number. Usually it'll be in the hundreds of millions or billions, is the share price times the number of shares. Okay. Now, if you, this $11 is separate, so just disregard this. So if you actually think about it, the company is the company. It's a tangible thing. It's a real thing. So if you increase the number of shares, then theoretically the company value should go up. But this doesn't make sense because fundamentally nothing's changed, right? It's not like there's a new factory or something like that. So what happens is when you increase the number of shares, you actually decrease the share price. Theoretically, okay? It actually depends why the company is raising capital. Usually it'll be either because the company is doing badly financially and they need more money from investors, in which case that's bad. They might be buying out another company, which is kind of a good thing, right? The company is growing and they're investing in the future. But ignoring that, just looking at the straight mathematics, if a company issues more shares, which they do with an equity raising, then the share price theoretically should drop. And in most cases it will. As I said, it depends why. So what will actually happen is this company might now trade at $10, for argument's sake, $10.60. It won't drop too much because there are already a lot of shares on issue. Okay. But the problem is the company doesn't know this yet. Okay, because this is after because what will happen is the shares go into a trading halt usually. So the company will actually ask the stock exchange and say, don't allow anyone to buy or sell these shares. They will make the announcement to the market. The shares will be in a trading halt, usually for a couple of days, and then the trading halt will lift. Okay, and then people can buy and sell the shares again. So the company is just sitting there going, okay, well, our shares are trading at $11. What should we offer the shares at? What they will usually do is they will say they should. They don't always. They will say either the lower of a set amount, so I'm just going to say $10, or the 5-day VWAP prior to a certain day. Okay? So what they might actually do, or at least what they should do, is let's say they make this announcement on the 1st of June and the offer closes at the 30th of June because, you know, they have to notify shareholders and then they need to give people the time to make the decision. So you're a shareholder and you get told by the company, well, hey, you can buy these new shares at either $10 or the 5-day VWAP up to the 30th of June. So the previous 5 trading days. Now, the problem for you is, I mean, you're sitting there and you're going, okay, well, I'm definitely not going to pay more than $10 because it's the lower, right? I have seen companies say the higher. So you have to read it carefully, but they should say the lower. So you know, okay, I can buy them at either $10 or lower. Because if the VWAP is lower, then I will get it at the cheaper price. If the VWAP is higher than $10, well, because it says the lower, then I will get them for $10. So you're actually kind of happy because you go, well, they're trading at $11. I know I'm not going to pay more than $10. Yeah, that's a good offer. I want to do it. But what happens is when the shares go out of the trading hole, they're now trading at, say, $10.60. And it's the 1st of June. And you don't really know what's going to happen between now and the 30th of June. So let's just say, for argument's sake, that the shares over the month of June do something like, let's just say they're at $11, and they actually do, you know, something like this. And by the 30th of June, they're at, let's say, for argument's sake, I don't know, $9.50, right? Well, actually, let's even just make things a little more interesting. Let's just say $9.90, right? Now, what actually happens is if you actually look at these 5 days, right? Because this is our 5-day VWAP. So on the 5th day prior to the close, they might have actually been trading at $10.15. So the VWAP might actually still be above $10, right? Because again, this is a volume weighted average price. So even though on the last day prior to the 30th of June, it was trading at $9.90, the VWAP is actually at $10.01. And even though the offer was structured at the lower of $10 or the 5-day VWAP, you would still buy them at $10. Yeah, sure, it's the lower, but that's actually lower than what the market is. Because the market is now $9.90. So you're paying $10 for shares that you could buy on the market for $9.90. And in fact, if you look at this graph, the shares might continue to go lower. And you don't even get the shares on the 30th of June. That's just when the offer closes. Usually it might be another 2 weeks after that before you actually get the shares. So you might not get them until the middle of July. By that time, they might be trading at, you know, who knows, $9.60. They might be back up to $10.50. Who knows, right? But that's why it's quite tricky. And that's why the VWAP can be very important with equity raisings. And I've seen some horribly structured equity raisings by very large, reputable companies. And I've seen it many times where shares have been issued to shareholders where they've paid above what the market price actually is. Now, part of it is just unfortunate, and you go, well, how would the company know that, you know, maybe there's some bad news and the whole share market drops? But sometimes they're just badly structured deals. And as I said, sometimes they might say the higher. Sometimes the price that they might set is not low enough. They might, instead of, you know, I said here it was $11 when the shares were at $11, they said the lower of $10 or the 5-day VWAP. They might have actually said like $10.50. And it's just not enough of a margin. So, but that's why the VWAP is important. You will never have to you should never have to calculate it. Okay, it will be quoted. So even with an equity raising, they will actually say on the following trading day, they'll say this is what the VWAP is. So you don't actually have to, you know, look up all the volumes and the prices and calculate it yourself. I should have said that earlier. But it is important, especially with equity raisings, because equity raisings, you can make a lot of money from them. If they're structured correctly, you should, in theory, they should be designed that existing shareholders can buy shares below market. And so if you've got the cash, generally speaking, and I stress generally speaking, you should be able to, you should invest as much as you can, as much as they let you. And, you can wait the 2 weeks and just sell them if you want. Get the new shares and just sell them, and make a profit, make a quick buck. But you also need to be very careful about how the deal is actually structured. And my very simple advice is, with an equity raising, always wait as late as you possibly can. There's no benefit whatsoever of saying, yep, I'll take part of this equity raising on the 1st or 2nd of June. Don't wait to the very last minute, because you might miss the offer, but wait as late as you possibly can, maybe a day or two, probably 2 business days before it closes. But anyway, I know that was quite a lot to take in. Again, don't worry so much about this top half. That's more the what it is. It's the why is it important that is obviously more important. But just at a high level, if you know that it's not just the average price, it is actually volume weighted. And this is how it's used in investing in the share market. But thank you very much for watching, and make sure you check out my other videos that give you lots of helpful hints about investing in the share market. I'll see you in the next video.